Good morning, everyone. I'm Randy Giveans, head of the Energy Maritime Shipping Department here at Jefferies, and would like to welcome you to Capital Link's webinar series. Today's webinar is a live discussion with the CEO of NASDAQ-listed Grindrod Shipping Holdings, focusing on the dry bulk sector and obviously the development of Grindrod. So we'll touch on some of the broader industry issues as well as Grindrod's strategy. Our discussion will be around 40 to 45 minutes with some Q&A at the end. So you can submit questions via the webinar screen, or you can email your questions to questions@capitallink.com. With that, I'd like to introduce our guest, Martyn Wade, CEO of Grindrod. Thanks so much for joining us, Martyn.
Absolutely. My pleasure, Randy, and great to be here.
Excellent. So if you can just give us a brief 2 to 3 minute kind of intro of yourself and Grindrod Shipping Holdings for those who maybe aren't familiar, and then we'll jump into some questions.
Thanks, Randy. We're an owner-operator. We own 23 ships. We have another 8 on long-term charter, all with options, most with purchase options. We're in the handy super ultramax space. And when I say operator, we've been operating cargo for over 40 years. So we are a genuine, we trade our ships a percentage in our own business and obviously on the market. So always trying to maximize the returns. We were part of a South African company. We got spun out 3 years ago, listed on the NASDAQ. We're Singapore domiciled, listed on the NASDAQ, and also dual listed on the Johannesburg Stock Exchange. It has been a little bit of a complicated structure. When we came to market, we had 19 ships in joint venture. Now we have none. So we have kind of tidied the structure up, made it more understandable. And yeah, it's been a tough few years, but the market is now obliging. My background quickly, 44 years in the business, worked for owners, brokers, operators in London, Johannesburg, New York, and now Singapore. So seen all aspects of it, all markets, from the rubbish all the way to the glorious and all the way back down again. I'm a director of the UK P&I Club, a director of the UK Defence Club, director of BIMCO representing Singapore, and also on the Singapore Maritime Foundation. So a lot of interesting people. And the whole thing about this business is it tends to be, it's not what you know, it's who you know, and be able to lean on people and try and work out what the markets are doing. It's a fun business. It always is fun. But at the moment, yeah, we're smiling.
Yeah, I can imagine. And 44 years, I guess you joined in kindergarten. So congrats on that early joining.
Straight from school.
There you go, yeah. All right, so as you mentioned, you're focused in the handy size, the Supras, the Ultramaxes, extremely competitive, even with Cape sizes today, right? And in recent weeks, pretty much all have been around and over 30,000 a day, so somewhere between 30 and 34,000 a day, right? So what is driving this kind of elevated and really tight range for spot rates across all the asset classes, and then maybe more specifically for the mid-size assets? What's really driving their performance? And is it certain demand drivers, certain commodities, certain routes? Because it's pretty remarkable to see them, for a time there, outperforming Cape sizes, and even now within, 10% of Capes.
Interesting. I'd actually argue that the 37s, as we're now fixing ships in the 40s, $40,000 a day, are starting to outperform the Capes. It's interesting. Across the spectrum, it's genuine demand. Q1 or end of Q1 last year into Q2, obviously with Corona, the world stopped. We always thought it would recover, and it has bounced back. And you look at a lot of the latest commodity figures, and it's difficult to compare shipping demand year on year because last year was so depressed. But we're now seeing reports that we're back to 2019 levels. In case of China, steel exports is back to 2017 levels. So the world has caught up. But with this, we're seeing an awful lot of demand, an awful lot of long-haul business. That in an old market, poor market, ships tend to trade Atlantic or Pacific. And if you want to get from the Pacific to the Atlantic, you always took an absolute bath to get there. Now, it's the same rate, whether it's front haul, back haul. And so ships are steaming an awful lot further. There's a lot of steel and generals moving from Asia. We're undoubtedly helped by the container market. It's hard. I don't like containers. I was around when more or less they first started invented, and bulk began going into containers. And it's annoying where you get steel, scrap, everything going in containers. That's coming back out again, and it's interesting. And you see scrap. We're seeing scrap cargoes we haven't seen in 10, 15, 20 years. And it's increasing. Places like Turkey, up 3 million tons in the first half of this year. People say it's only 3 million tons. Yeah, 500,000 tons a month, all from the continent, all on Supramaxes. It's a lot of ships. And this is what we're seeing. We're seeing trades that we haven't seen in a long, long time coming back. And a lot of them tend to be very long haul. So it really is stretching the fleet.
Okay. And yeah, clearly there's been, a major focus on the major bulks, right? Iron ore, coal, what China's doing with their steel production, what Vale's doing with their iron ore production. So can you give us maybe some insight on the minor bulks and some of the ag trade? What are your demand expectations for these products in the back half of this year into 2022? I know there's some seasonality involved, but if you can touch on some of the minor bulks and the ag products.
It was interesting because I think to a degree on the smaller sizes, it was the agricultural products that kick-started it last year, where China had the biblical floods in Q2 into Q3. And it became apparent that a lot of their crops had been wiped out. The official argument was, oh, don't worry, we have huge stockpiles. In reality, I think we all discovered that those stockpiles weren't there. So they've been buying grain I can only rival it to when the Russians came in 1986 after Chernobyl and began buying off America. It's record amounts, and they continue to do that. You see all their latest soybean figures for the first half of the year, up 3-4 million tons. So this is continuing. But I think this also spreads around the world now after Corona. And I keep on saying it, we don't have just-in-time stockpiles, we have just-in-case. So I think an awful lot of countries now are having to have, at the end of the day, you've got to keep people fed. If you don't keep people fed, you've got a problem. So this is the first start, and then of course putting people back to work. So we're pretty confident. The forecast always was for the grain trades to increase steadily, but I think from Corona we really had quite a kick from that, and that looks to be continuing. And then you add in, yes, China producing steel, but it's now exporting steel once more. Yes, you've got the major bulks, but with the disconnection with China not buying coal from Australia, fantastic. So they're now getting it from the latest figures, the US and Canadian exports of coal in Q2, fantastic. That's genuine tons sea miles. Yeah. And so, of course, Australian coal became cheap, so they start selling into India, which tends to be a super ultramax business. That displaces South Africa, traditional market, so they sell to China. So all in all, it's kind of feeding on. It's almost a perfect scenario happening at the moment, overlaid with the demand coming out of containers. So it is genuine. And of course, we don't have any new buildings. The handys always traditionally, there was never any money in yards building handys. So this has been a bit neglected. And yes, our 37s are the stars, but the 28s and 33s, I mean, when you're fixing 28s at $28,000 a day, you can't complain.
Yeah, I can imagine. Let's touch on two more macro questions. One is China, steel production, trying to maybe curtail some pollution and emissions and all these other things. So can you touch on that, and how big of a threat is that maybe to iron ore trade? And obviously that trickles down from the capes to the smaller asset classes as well. But I know that's been getting a lot of press and a lot of client attention, is kind of the concern around Chinese steel production and curtailments there.
It's interesting because, of course, all the figures, Q1, Q2, China's steel production, absolute record. But also what's so important is global steel production outside of China is at record levels. So there is genuine demand there. And I think the pollution with China, it gets back to taking higher quality iron ore, higher quality coal. And steel is such an important part of their economy. And ultimately, you're employing people. And the one thing after Corona is that, with the furlough schemes, I think you have to keep people working. So we're not that concerned. Yes, obviously, if China slows down, it does have a knock-on effect. But elsewhere in the world, I mean, obviously now China, we got the issue with localized lockdowns. And is this going to happen? I mean, I saw a figure the other day. There's 50.5 million deadweight of ships tied up in China. It's the biggest amount since 2013. And that's all in congestion, delays. So there's a whole load of factors playing in here. So yes, China can slow down. Last month's iron ore figures were down when everyone was going, oh my God, it's off 12 million tons. But until you compare it to the year before, it was up. So I think at times China continues. I think that there's a level they have to stay at. So I think people trying to second guess China. You can't. And ultimately, the Communist Party is going to keep people working, the mills working. And yes, they will do everything on green issues, but they also need to keep people employed in industry. So we're not overly concerned by that.
Okay. And then one more macro question. You're seeing a lot of headlines, especially here in the U.S., around infrastructure bills and spending, $1 trillion, whatever it might be, $2 trillion, whoever knows the number. How does that going to impact kind of the trade for cement and bauxite and minor bulks and kind of dry commodities here in the U.S.?
If only, oh my word, if America starts on a little bit of infrastructure, it's fantastic. Yeah, we're already seeing a lot of steel. I mean, there's 10 to 12 shipments a month going from South Korea into the States. There's another 3 or 4 going from Taiwan and Vietnam and places. So I think that the steel, I mean, your steel price is the highest in the world. I mean, you're $400 higher than Europe, which doesn't make sense, and over twice the price of China. So I think kind of needs must. But if you go back to Hurricane Katrina and what happened with the market there, where the American government then really did start rebuilding, the amount of cement that went, and if you're going to buy cement, but there's only one country affected in the world, that's China, and it's ton sea miles, and that really took the market at that time to the next level. So any kind of infrastructure spending is going to be very positive. And having lived in America and gone there a lot, I keep my fingers crossed that we can start a modicum of this, because I think it's going to be very, very interesting for all aspects of dry bulk.
Sure. Yeah, being from New Orleans, I know all too well about Katrina, but
yes.
Side note. All right, so I guess looking more directly at Grindrod and maybe your fleet, the vast majority of your vessels are Japanese. You've stated several times kind of that access to key Japanese industrial, financial players. How is that a competitive advantage for GRIN, and kind of what are your benefits there for this Japan-focused strategy?
But obviously, this has gone back 25 years now, where when the original Island View decided to get involved in ship chartering, long-term chartering, went to Japan, and we've developed. The Japanese build the best ships. They are the most eco. The design that is fact. So we kind of modelled our whole business model on buying Japanese, chartering. You get the flexibility. It takes an awful lot of hard work. Now, I've been going there until recently 4 or 5 times a year. You go there, and it's a lot of sake, a lot of karaoke. When my family have been there for ship launches, the girls just shake their heads and go, "You got to be kidding me, Dad, you can't sing." And then I get a round of applause. I said, "How was it?" They said, "You were shouting." I go, "All right." It works. And once you become friends there, it is so important. And from that has come whereby we now have Japanese bank financing, where the banks approached us. It's a long-term game in Japan. You listen, you're patient. I've sat on so many sofas for 10, 15 minutes, and go back 3 months later, and then they say, "Oh, maybe we should have a lunch. Would you like to do a deal?" It just takes time. They're always kind of assessing you and weighing you up. So that's given us that access. And in the last couple of years, we've done some amazing sale and charter back deals with incredibly low interest rates, where the Japanese owners are looking for to defer tax. And so they then pick the right counterparty. And as they always put us up there, ourselves, Ultrabulk, FedNav, there aren't many that haven't ever renegotiated or changed their minds or altered deals. And we guard that, and we get it back. Last June, July, when we took the view that the market was going to recover, we went to Japan, booked 6 Ultramaxes for 1 option 1 year. The Japanese were happy to do it. They started delivering at the end of 20 into 2021. Now, the base rate on those ships is $9,000, $10,000 a day. I mean, you pinch yourself now, but this is where it comes in. You say, we'd like to do a deal. At the time, it was the market, and they trust implicitly, because we've always honored everything. So it's an incredibly valuable relationship, especially in shipping these days, where relationships aren't necessarily doing a handshake. It's not like the old days, but with Japan, you can.
Wow, okay. And then staying on your fleet, as you mentioned in your opening remarks, you recently announced that the company is acquiring the remaining, I think, 31% or so equity stake in the IVS Bulk joint venture. So now your ownership is 100% on all dozen of those vessels. So this has certainly been a major objective. I remember speaking with you at a conference a few years ago and saying that was a big strategy of yours. So what does this mean now in terms of operational and financial performance for GRIN? And then further, how did you weigh this option versus growing the fleet via secondhand acquisitions? And how do those vessels compare against what you can find in the S&P market?
It was interesting. We obviously always knew that our first partner, Regiment, we bought out in early 2020. And we always knew that Sankati Bain Capital at some point would want out, but they wanted to see the market develop. And the values obviously did recover. And so when they came and said in April, we'd like to kind of get out, we said, fine, we had a view of the market. Obviously, it was pegged at early May values. So I don't want to say too much, but we're sitting here now, yeah, with very good appreciation. And when we actually consummate the deal, hopefully in the next few weeks, we'd basically had all the earnings from the 1st of May. So it's been very, very beneficial. It was a no-brainer for us because, of course, Randy, we ordered these ships from new with some of our own spec on board. So we knew the ships, we knew how they perform. And even going back then, we'd have been hard-pressed to have picked up, four ships at the kind of levels. We did market levels, but as we know with market levels, if you're a seller, you look at market level and add on 10 to 15%, 10 buyers turn up, and suddenly that's the new market level. So we did think long and hard, and internally we had to justify it to the board. But with hindsight, it was a no-brainer, and we were always going to pick them up. Obviously, if our partners had turned around in, who knows, 2 years from now, who knows, it would have been, but at the time they wanted out, it'd have been a great relationship. And so it was good. And it's the ships we have, it's the ships we know, trading them, and we're very happy.
Okay. And then stay on your fleet one more time. Part of your strategy is to charter in vessels, right, for a short or long term. You have those 8 Supramaxes under long-term charter-in agreements with the purchase options on a number of them. What does this mean in terms of valuation, purchase options, operational results? What are the plans for those?
It's always interesting, the long-term charters, where for years we were crucified. Oh, you've got these deals, 12, 13,000. Yeah, okay, well, we've got them, we've got purchase options. Yeah, but they're, on a 5-year-old ship, $18 million, you've got to be kidding me. Yeah, right, okay, 5-year-old ship now, $27, $28 million, okay. 13,000, 12,000 as base levels. Yep, thank you. It was always there. Yes, obviously the market has helped, but we always had a strategy. You need a core fleet. A mixture of owned and chartered. Obviously chartered, you're using someone else's balance sheet, but also because we have, at times we have some dedicated business. We've deliberately only got our long-term business now. We deliberately didn't take any other cargo middle of last year, but you need those ships to perform. It's high value commodity. You have a lot of index linked contracts, so we're not exposed to the market. And if you're carrying high value commodities with blue chip charterers, they expect performing ships. It's as simple as that. So those ships, yes, it's a nice position to be in. We've got 5 older handys, owned, very little debt on them. Obviously, the values are up. Can we sell them down the line? Do we exercise the purchase options? Do we flip, or do we take these ships in to be core in our fleet? Well, that market will dictate that. But it is a very nice position to have been in, whereby, a few years ago, we probably couldn't have dreamt it would be at these levels. Now, it's a nice position, yeah. As my CFO always says, he spent years wondering where he's going to get the money from. Now he's trying to work out how he's going to spend the money. It's a great idea.
Yeah. And we'll get to the uses of cash in a little bit. But when do those charter options kind of come to fruition? When can you either flip them or purchase them?
We've got a couple of them already that we've had now for a couple of years, so that we can exercise. And obviously, on some of them, they are depreciating as we talk. And there are a couple of others that will, in the middle of next year, that will come. And obviously, these were all done a long time ago at values at the time. So now, with a new building Ultramax at the moment in Japan, 35 million. I mean, handys are pushing 30. So wow. These are in the money. So we have that flexibility. Like any good market, if you do decide to sell, you can never get out at the top. You've got to be selling to someone else who still has the dream. So it is a matter of working it out. But I think a number of those ships will become our core fleet. And of course, with ESG going forward, if we do that, I mean, our oldest ship would be 14 years. So we'd have a very, very modern fleet. I think that is so important with the way the world is going forward.
Sure. Yeah, and then to those on the line, I see your questions. I think we have 7 or 8 right now, so keep those coming. I'll be sure to work those in during the Q&A and then at the end. Next question for me. Grindrod, has a very active cargo operation. You're running 2 pools, a handy-sized pool and then a super ultra pool. How do these pools kind of impact your operations and profitability?
Well, the pools now, obviously the Supermax Ultramax was because we had the Sankati and originally Regiment in there. So that now falls away. So it's 100% our own ships.
Okay.
And on the handies, we're down to 1 externally managed Japanese ship. It's always the case with the Japanese. We're trusted. In times of bad, they'll put the ships with us because a pool obviously outperforms. When the market picks up, a number of those Japanese owners have withdrawn the ships and sold them or go for fixed employment. We get off with some of them we've taken. They always offer them to us as fixed employment. So that has gone away. On the cargo, yeah, we still have probably a 10% cover with cargo. But very specifically last year, we just weren't interested in booking other cargo. It's purely our core. Because as we've seen with the market now, you put cargo last year at 10 grand, you're paying ships 40 grand now. Yeah, you can lose money pretty quickly. So I think when you get a market like this, you really have to say, right, we're going to be long of ships and we're going to enjoy this market and let's see how it takes us.
Okay. And as you mentioned, right, asset values have gone up dramatically here, especially year to date. Steel prices going through the roof, berth capacity is very tight. Obviously, the earnings that you can get on a ship are elevated. So reflecting on that, is it still attractive to invest in second hands or new buildings? What would your focus be? And if it was on new buildings, what kind of vessel would you buy, right, with all of the uncertainty around emissions and propulsion and regulation? Can you give some insight on that?
I think with no way new buildings, you just can't do it because also as an owner, that I learned many years ago from a Greek friend was that as an owner, you have to see what the general everyone's building. Do not be the first at the front of the queue because you're either very, very wrong or chances are very, very right or very, very wrong. And you go back to the 70s where they had gas turbine engines. My God, the people went bust. So I think you have to watch and wait. The world is going to change. Is it going to be hydrogen? Is it ammonia? We'll have to wait and see. The world has enough ships at the moment, secondhand. Still to invest, we're a little cautious at the moment. But then again, having the purchase options, we have that ability to look at them. So I think you have to be a little cautious now. And we've only just started. We were on Marine Money a little while ago. I think with Magnus from 2020, I think asset prices can go an awful lot higher as we're seeing a lot of the Greeks buying with a 2-year rate on an Ultramax now for a Japanese one, 25,000. You're buying a 6-7-year-old one of these at 22 to 23 million. I mean, the cash is phenomenal. So asset values are still very underpriced against rising new building prices due to steel prices, due to the lack of labor. And thankfully, all the liner boys, container boys have filled the yards. Thank you very much. It's similar to what happened in the 2000s, where, trust me, after 2 years of a good market, all the lemmings in the dry would have gone to the yards, ordered. They couldn't. There was no capacity. Now, yes, there is capacity, but ESG, finance, it's good. It's real discipline at the moment. Who knows? Another 12 months of this, and we'll see what happens. But for the next couple of years, order book looks very, very manageable, and we're very comfortable.
Okay. So we talked about the demand drivers. We talked just now about supply and the very low order book, very low fleet growth, especially the back of this year, 2022, really into 2023 for that matter. So I guess operationally, environment, what is the kind of biggest risk to the thesis? Is it demand driven? Is it further COVID lockdowns? What could go wrong here? Why aren't rates going to stay at these levels for the next 18 months?
Well, I think they could stay at these levels or could go higher. The thing about shipping, it never stays at a level, does it? There's always volatility.
Sure.
What can go wrong?
What's the downside risk? Yeah.
Yeah. I've got to assume it is COVID, Corona. If we were to get general lockdowns, but as I say, I think the world has learned to a degree they have to live with it. And what happened before, obviously, we know a lot more about the virus now, and I think, yeah, it's. I don't want to tempt it, but at the moment, we never saw Corona coming. At the moment, all things considered, this looks like a genuine demand-led market with no new buildings coming. So yeah, we're always wary, always watching. But yeah, I wouldn't like. I mean, is it like a green event? Is something going to happen? But the world needs commodities at the moment, as we're seeing, and shipping is the one to. It's surprised me, not only our own share price, but others, whereby everyone's getting excited about commodities, but there's only one asset class that carries these things, and that's us. Yep. So the demand is there. So I don't want to jinx it, but yeah, I can't at the moment off the top of my head, apart from if the pandemic was to really kind of take a turn for the worse and get out of hand. But even then, people have still got to be fed, which is grain, which is the small ships, and to a degree employed. Yeah, fair. Quietly confident.
Okay, noted. I can tell. Going back to kind of Grindrod specifically, right? You've been reporting on a semi-annual basis for a long time, and as recently announced, you're now going to quarterly basis, which I certainly recommend and applaud here, bringing you in line with your other U.S. listed peers. So, what kind of drove this decision? Was it regulatory? Was it an effort to maybe attract new investors? And what challenges has this transition maybe presented? And how's the process going?
It was purely because, as I say, we came to market with a very complex structure, and we've been trying to simplify it. And the first time, I met you, was in the States with my CFO, Steve. Everyone was saying, you're too complicated. I mean, the whole scenario, and you're not quarterly, you're invisible. So we had to work on this, but we also wanted to be damn sure that when we do go quarterly, we got all the systems in place. And yes, it has been a bit of a, shall we say, dragging a few people over the line, but we are there now, very much to be more, US centric, focused, in line with all our peers, and going from there. So it has taken us a bit too long. Obviously, with Corona last year, that didn't help. We were going to look to do it last year, and then we thought, well, let's see, because of the uncertainty. But very much, we are a NASDAQ listed company. That's where we want to be. So we have to make ourselves as understandable as possible.
Yeah. Yeah, I remember that meeting fondly. I was saying, you have these dry bulk vessels, you have tankers, you have a lot of these joint ventures, you have semi-annual earnings.
Yeah.
Okay,
all right, okay.
All right. But you fixed those things. You fixed those things. Yeah, exactly. I'm saying, look how far Grindrod has come. So very nice. 2 more questions from me, then I'll get to the 12 questions now that we've got from those on the line. So last 2 for me. Your primary listing is on NASDAQ. You have that secondary listing on the JSE in South Africa. When you got listed in June of 2018, I believe, all your shareholders were holding JSE shares. You described in the past that those shares bought on the JSE could seamlessly kind of convert into NASDAQ shares. How has your U.S. shareholding base kind of developed since that listing 3 years ago?
It's been tough because, of course, when we came to market, what we'd like to have done would have been, if the market had been there, would have been an equity raise, and we could have got more on the NASDAQ. So without that, we're now up to close on 25%. So it's getting better. For us, it's very important. Our board knows that we need more shares on the NASDAQ, because the NASDAQ volume is 5 to 10 times the JSE volume, and the price is set by the NASDAQ. So, the volume is better. We've had some spectacular days, and initially it was the Robin Hood boys all piling in. We all get very excited, and then, we're back where we started at the end of the day. Now it seems to be more genuine, but we're also very aware that we have investors, funds out there that maybe would like to buy shares, but if they want to buy 1 or 2%, they can't take a month of Sundays to do it. They've got to be able to go in, and also they want to get out. So it's something we're very, very aware of, and we're working very hard on. And I think the way the market's going, shares price, you'll get more sellers in South Africa that can be seamlessly moved over. And we know of 1 or 2 US-based investors that are doing that, just hoovering them up there. And then it's a matter of simple paperwork, get migrated across and move on.
Great. All right, last question for me, then I'll turn it over to those on the line. After pretty much a rough decade, right? I joined Jefferies in May of 2011, and it's obviously been 10 years, and there's been some good times, but it's been pretty rough overall. That said, now dry bulk is back to profitability, right? Your demand drivers are very firm, supplies in a great place. The balance sheets for pretty much all of these companies, yourself included, is in the best shape it's been in a decade. So with that, we know you've yet to report your 2Q21 results. I think that's coming in a few weeks here, so maybe not specific on profitability, but obviously it's probably safe to assume with the rates you're throwing out that 2Q is going to be good and 3Q is looking even better. So with that, we've seen a number of dry bulk companies initiating some new dividend policies. We've seen some buying ships. We've seen some do tender offers, share repurchases, whatever it may be. So your actions, the strong market, what are your priorities here around capital allocation? Is it to further repay debt, to pay a dividend, to repurchase shares, to buy ships, all of the above? Kind of if you can discuss those kind of capital allocation priorities.
We're flexible. I mean, I'm old school. I do like the Greek model of having no debt. I'm not saying we're going to go there, but you have to have a manageable debt level. We're now in that position where the cash is coming in, and to be able to reduce our repayments down a little bit, that would be good. But like all dividend policies, at the end of the day, it's like a lot of our peers. If it's not reflected in the share price, it's how we balance between generous dividends and the share. So it's something that as a board, we are sitting back and we're smiling. And I think it's probably more or less everything you say. We're in a great position. And it's a matter of now how we use it, bearing in mind that markets can change and you don't want to be leaving yourself short down the line, or you just. I view this as a great opportunity after 10 years. To us, when we were spun out, we probably had too much debt and there were other issues. We're now in a position where that doesn't exist. So we have to use this, as all shipping companies. Let's not get carried away. Make yourself sustainable, and yes, it's at a cost base. I know that John at Genco has said about reducing debt, and I think we're a combination where you've got to be in the game irrespective, and go forward from there. But we are going to be. Let's see. I mean, the market goes up another 10, 15,000. Hey, then you're right. It's the balance. Well, we're watching with interest what our peers are doing, and we're very much going to be in line. But it's happy times, Rand. It's happy times.
Sure. Yes, it's a good problem to have. Too much cash, right? But yeah, it's been kind of crazy seeing these new dividends policies being announced, earnings going where they are, rates going where they are. Yet the equities, especially in the last month, have really been selling off. So my guess is that earnings season, obviously this week's very busy with numerous dry bulk companies coming out, your results coming out in a few weeks. 3Q quarter to date rates are going to be very big, dividend announcements, all these other things. That should kind of boost shares. But let's get to some Q&A here. Let me pull up the list. I know a lot of these we've already answered, but I'll ask a few of them anyway. Okay. First question, can you maybe address some conditions in China? The market is projecting right now that China is shutting down, right, due to the Delta variant. What conditions are you experiencing there?
It's very much localized. What we're seeing, we're hearing nothing about a national lockdown there. And being China, it gets very targeted. They can close whole cities or lock up towns very, very quickly. So what happened in, was it February, March last year? We don't think that's going to happen. I say there's far more understanding. And the Delta variant and also the figures, yes, I mean, you don't want to get this thing, but the mortality rates, people getting it. And I think the Chinese are clever enough to have to work this one out. So it could be very much in certain areas, as we saw with Shenzhen, was it a month, 6 weeks ago, what it did to the container market there. It could actually, in a funny way, shipping is always a funny business. We kind of thrive on disaster. It sounds terrible, but it is the nature of the, so I think, never say never, but I don't think it's going to affect, I think people are reading maybe a little bit too much into it because the Chinese are very, very capable at sorting this kind of problem out. Sure.
And to be clear, you are seeing Grindrod ships going in and out of China today or this week?
Yes, and we still do dry dockings. We have to be very careful in terms of planning ahead, because you don't want the 14-day dry docking. But no,
Right.
it tends to be localized. And the Chinese, with the right information, you can be ahead of it, what's going to happen, and try and avoid it. Yeah.
Okay. Quickly on this one, I think we already answered it, but for the JV interest, you were able to lock in asset values based on the April-May values, correct? And are there any issues that still need to be negotiated on that roll-in?
No, it's all signed, and we're just sorting out the finance, be it a mixture of bank and cash at the moment, which is basically, it's just now paperwork. So that should all be resolved in the next few weeks.
Okay. And then here, interesting about the elimination of the front versus back haul differences. How does that impact your cargo book and your ability to generate TCE rate outperformance?
We've always had, our backyard is the Indian Ocean. We trade internationally, but we've traditionally had the Indian Ocean. So we tend to operate on that. And I say, we have a lot of index-linked contracts, so we are not exposed to the market. And yes, I mean, we're taking ships on short period to cover it. But if we know that what the first couple of legs are, then what we're seeing fantastically is we have the optionality where you end up having performed the minimum period, you still have another 3 or 4 months. And the way the market's moved, you're actually 10 or 15,000 below the market once more. So we can capitalize on it. So it's a nice position to be in, but we're not taking any risks or booking anything at city levels. Yeah, where the Pacific is stronger than the Atlantic, and where you're getting backhaul from the Pacific at 35, 40,000 into the Atlantic. Yeah, there must be some people being killed on that. But we've deliberately stuck to our knitting where we want to do it, and minimizing the risk. We use our own ships to position into South Africa and into the Atlantic accordingly. And as I say, where we do take ships in, it's fine, but it's calculated, and at times, as we're seeing now, we have the optionality at the end, which is glorious.
Yep. All right. Grindrod charters in some additional tonnage to expand operating leverage, flexibility. How helpful has this strategy been in the recent high TCE rate environment? And on the other hand, what's your approach to maybe locking in some TCE rates at levels that appear to be, well above average? Are you looking at kind of any time charter outs here?
Well, obviously, we're being an out-and-out owner-operator. We're always in the market for ships. So basically, especially Indian Ocean and areas we trade. So we're always seeing what ships, every owner, the brokers will come along, this ship's interested in period at this level. So we're always looking at the whole time whether we can then arbitrage against our own ships, take in someone else's ship. That's ongoing. In terms of fixing out, not at the moment. It's interesting, you go back to 2003 where the market took off there. And I got caught, a lot of people got caught, because every time there was a hiccup, you kind of almost panic. Oh, it's over, it can't last. Learned from this one, where we started this one, I think it's genuine. So we are basically trading more than 100% spot, because the levels we're at, our cost base is so good in relation to the market. And yes, there will be a time to take cover, but the discount on cover to spot earnings is pretty meaningful. So the moment we are still preferring, every now and then, if someone comes along and offers one of our ultras 35,000 for 4 to 6 months, yes, we'll take the odd one out. But basically, the whole fleet is trading spot, and we're thoroughly enjoying that. And at a time, it will be a matter of when do we want to take cover. As usual, taking cover, you've got to trust the counterparty. Are you going to get up with the daisy chains where you have 8 or 10 people in it as it gets relet? And of course, when it all goes wrong, it all comes back, the most bankable in the chain. You've got to be very, very careful. Cargo, again, we book cargo, take cover, but will the guys renege on it? I mean, it's exactly as it was in the past. So we would rather have control wherever possible of our own ships, and the people we do trust tend to be our out-and-out competitors and vice versa. And they're not going to take our ships, and we're not going to take their ships. So, it's a fairly limited pool of people we trust, sadly. But at some point, we will. If the Japanese were to start coming in for ships and who we trust, that would be interesting. But at the moment, we're enjoying running spot.
Okay. All right, we got 3 questions in one here. Contrary to history, we're seeing a large focus on shareholder returns, very attractive payout policies emerging in the sector, Starbulk, Genco, for example. Can we expect Grindrod to follow this trend to the same extent throughout the top of the cycle? Second part, what is your ballpark estimate for Grindrod's NAV? Third part, how do you view share repurchases at these levels?
Well, let's answer it reverse. So share repurchases at these levels, we did some and then stopped. We're in a closed period, so we have to abide by the rules. But yeah, at these kind of levels, NAV, we don't publish it, but it's an awful lot higher. We are probably trading at a bigger discount than anyone else, especially with the Japanese fleet. You can benchmark and some of the values I've been talking. So yeah, I mean, from if our share price wasn't to react, we would have to potentially look at that because, yeah, it's annoying.
Yep.
And in terms of dividend policy, we're going to try and be flexible. Yes, it obviously depend on how much we're making, and it'd be balanced. And to be honest, we want to make it sustainable. You don't want this kind of couple of quarters whoopee and then suddenly there's a hiccup. So what we want to do is have something that shareholders, it might be variable, but at least they know if we're making money, they're getting returns. And the market stays up. Yeah.
All right. Next question here. Do you foresee or expect any seasonality this year? What's your outlook for fourth quarter 21 and first quarter 22? And I'll add a little bit of color here. I was looking at the forward curve for those kind of periods. And pretty much in every asset class, you see a big drop off, right? From fourth quarter rates on the FFA curve to the first quarter rates of 2022. Clearly, the FFA curve is showing to a lot of seasonality. What's your thoughts on kind of expected seasonality in the next 6 months?
Well, we're now going into traditionally the strongest part of the year. I mean, I still hope that happens because, of course, we didn't have a Chinese New Year this year. So we went all the way through Q1. Q2's been very good. It's shaping the way it is into being a very good Q3 and into Q4. $1 million question. Chinese New Year next year, but with what's going on at the moment, can I say that will they allow 800 million people to go off again, or will they do exactly what they did this year? I suspect there'll be an element of control because this thing is still around. So we expect it to come off. I mean, the paper's fine, but the paper's just sentiment. You know, people are always kind of, it must come off, it must come off. And as we're seeing now, as the paper rises, more people are buying into the market. But yes, I mean, we bought some paper as a hedge for next year some months ago, and thank you very much. It's too cheap. And then you go into 2023 where Supermax paper is, what, 13.5? I mean, it's nuts. But it is what it is. So I think people are very much concentrating on the short term. But yes, all eyes on Q1 2022. Will the Chinese let 800 million people go home? I have my doubts again. So maybe, just maybe, it might not be for the second year running, the normal. To be honest, back in the 2000s, we never saw a massive. There was at times there was, a bit of a sell-off, but at the peak of the market, it was pretty healthy all the way through.
Okay, a few more questions.
Sorry, Grant, to be honest, if the market was to come off 10 grand from today, okay, we're only earning 25 grand a day. Okay, all right, we'll put up with it.
Got it. Yeah, that's fair. A few questions here just for clarification. Percent of ships that are exposed to spot, you said almost 100%?
Yeah, I think we probably got about 10% cover overall, so 90% AC trading spot, yeah.
Okay. Are the purchase options set, or is the price negotiated once you exercise the option?
Always set in the charter party, be it dollars or a combination of yen and dollars, and generally some of them are depreciating, and of course, with the dollar, the yen at 110, it's quite good. Others are fixed in dollars, and every year will come down. So, but no, it's fixed at the time of the charter, and the owners these days always pick it at a level they never think we'll declare the option at. Now, of course, it's yeah, strange things have happened. Yeah.
Okay. Someone else here asking around. I didn't hear the answer to GRIN's NAV. I'll answer that for you. He says it's a greater discount than peers. Peers are at 20 to 30% discount. So you can infer that it's much higher than that in terms of their NAV relative to the $11 share price. Is normalization of relations between Australia and China a big risk?
Yes, wouldn't want that to happen just yet. I'm not sure that's going to happen. And you can see what China's now doing with Australian iron ore imports in Q2, 4 million tons down. They are trying to, they can't get away from that, but they are trying to shift away. I think this has gone so far now whereby it becomes a matter of principle and is one country going to back down? yes, I don't think they can stay enemies forever, but at the moment it's working quite well. And to be honest, I think China, we know China, I mean, Chinese thermal electricity generation is what, 76% this year. It's breaking all records. They need the coal. So at the moment, maybe it does happen, but other countries also want the coal. You know, at the end of the day, it's coal isn't going anywhere at the moment. It will eventually. So I think there's enough competition out there from other emerging markets and also the world recovering generally. But yes,
Sure.
It is the most perfect trade war, at the moment.
All right. Two more questions here. One is, what kind of impact would the EU proposal to require shipping to participate in the EU emissions trading scheme have on your business? You know, given that even modest bulk carriers burn around 20 tons of fuel a day under kind of full steam conditions.
It would be, and obviously, Director of BIMCO, we're taking this very seriously. Is that we would rather lead, not let EU kind of come up with legislation. But at the moment, it's going to be taxing the older, dirty, polluting ships. So if the tax is there, it's across. We would still have a better fleet than a lot of people. And on this market, it'll be passed straight on to the charterers and the end consumer, as it always should be. So it'll be part of the business. Now, as with slow steaming, do charterers then differentiate between better performing ships? We could well see that. And you could get a 2 or 3 tier market. And obviously slow steaming. So we're watching it because we have a modern fleet. It's not a concern at the moment, depending on how the legislation ends up. And if it does end up, we've all got to participate, then guys with more modern green ships should actually benefit.
Okay. Last question here. How would you compare or describe today's business environment with the most recent bullish environment in terms of duration, demand supply, fundamentals, profitability, etc.?
Interesting, because of course the last one came out of the blue, China into the WTO, and we just didn't know how long it was going to go. Now you look back, the reason it lasted so long for dry was that shipyard capacity was so low, and the shipyards were full of liners and tanker orders. And by the time the owners of dry could order ships, it was 2007-8 for delivery 2010. We know what happens next. So this is different. Yard capacity is higher, although it's a lot less than it was at the peak. I don't think we're going to get greenfield yards suddenly setting up. As you mentioned earlier, I mean, what kind of engine? I mean, there's a whole load of risk attached. So as usual with a ship, you will only know how long it lasts after the event. But at the moment, on the basis that no new ships are coming over the next couple of years at least, that's always a good sign. And that is the positive. So at the moment, it's genuinely big demand led. Maybe that alters to a degree, and it could then be supply constrained, whereby the ships aren't there. So it's looking very, very positive. But as we saw in 2003, it lasted for, well, in reality, 2011 was still a glorious year. It went on a lot longer than people thought. So this one, I suspect it could surprise people on the upside. And as to whether we can get to, I don't know about Capes handies at 50, 60, 70,000, but I said earlier, well, some of our handy earnings aren't far off that. So it's interesting. It's a genuine market out there at the moment.
Excellent. Well, hey, thank you so much again. I'm looking at your press release here. It says that you plan on releasing earnings for the first 2 quarters the week of August 16th. Is that still the case? Do we have a specific date yet?
Hang on. The actual date is, what do we got? We got the board on the 18th. We'll be releasing on the 19th. Yeah.
Excellent. Sounds good.
And sorry, Randy, we're doing the quarters on the basis that we're actually retro doing quarterly reporting. So we want to do Q1, Q2, so we can get the comparisons there and move forward from there. So, and as usual with shipping markets, I think investors are only looking forward. They're not so much looking backwards, but we want to be able to compare against our peers like for like. Very important for us.
Yeah, showing first quarter results, second quarter results, maybe some third quarter guidance, quarter to date rates, all those things. So,
very much so.
All right. Well, we are 2 weeks away from that, so we are certainly looking forward to it. Thank you so much, Martyn Wade, CEO of Grindrod Shipping. Also, thank you to Capital Link for setting up this webinar series. And yeah, looking forward to the exciting times of dry bulk ahead.
Thanks very much, Randy. Appreciate it. And you, Nicholas, at Capital Link and all the team. Much appreciated.
Awesome.
Thank you.
Have a great day,
Cheers.
everybody. Bye.
Bye.